Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Real estate investment trusts, REITs, a vehicle that allows common investors like you and me to participate in the rapidly growing commercial real estate sector in India. I'm talking swanky, large grade A office spaces, mega campuses which are being rented by top dollar MNCs who are, of course, operating their big, large global capability centers here in India. And then, of course, there are, swanky malls, warehouses, and now even the data center promise. All of this is likely to boost non-residential real estate in a big manner. At least that's what the industry estimates are saying right now. So here are some numbers. From less than a market cap, a total market cap of less than 1 trillion USD, to be more specific, we're talking about 0.3 trillion USD. The Indian real estate sector, according to estimates of a lot of the consultants and CII itself, it's expected to scale up to a level of $5 to $10 trillion by 2047. That's the Amrit Kal dream. This means from accounting right now to about 6 to 8% of Indian GDP, the sector can potentially start contributing anywhere between 15 to 20% of India's GDP by 2047. Now, those are big numbers. So REITs do allow us ARM investors to be a part of this mega transition. SEBI has also given this instrument a more favorable play from a regulatory perspective. So is it really time to give REITs a very serious look when it comes to our portfolios? That's exactly what we discuss on this show. And to help us demystify this investment class, we have today Vishal Dhawan, founder and CEO at Plan Ahead Wealth Advisors, as well as Ashish Shanker, MD and CEO at Motilal Oswal Private Wealth. Gentlemen, thank you so much for joining in. A couple of months back, we did a very basic primer on REITs on Let's Talk Money. And at that time, I must say, REIT prices, just if you map the one-year chart of some of these listed REITs, they hadn't run up. But now we're talking, 20% plus in most cases. What's really going on? Ashish?
Yeah, so I think, Surabhi, it's important to sum up what's happened in the last 1 year. And in that context, how should people look at allocating their capital? It surely is becoming a very important asset class. And I think it's a very opportune time we are doing this for your viewers. So REITs, simply put, is fractionalization of commercial real estate, rented commercial real estate, right? Because if you directly go to buy a commercial real estate, it costs a lot of money. I mean, it could be in the region of 10, 20, 30 crores, right? Now, REITs allow retail investors to own units of a large pre-leased commercial property, right? Now, secondly, people should not rush in to buy these REITs just because they've gone up 20, 30% last 1 year. They're not exactly equity shares, right? Yeah. They own income earning assets underlying the structure. So let's understand what are the three components of the income, right? First, all these REITs are supposed to have minimum 80% of income earning assets, right? So they get rent out of these assets, which are basically leased out by software company, GCCs, or any other commercial establishments. That is point number one.
So REITs earn from that rental income, first
That's
of all.
right. That's right. Second, the rules say that 90% of the net distributable cash flow has to be given back. So there's certainty that the money is coming back to you as well, right? So there is a certain income yield on REITs. That is point number two. Point number three, right? There is an escalation in rentals which happens every 3 years. So it's generally 15%. So to that extent, the capital values of these REITs also get re-rated.
Okay.
So broadly put, I'll just explain the maths. Let's assume a REIT is earning a rental yield of 7%, which means if the REIT is valued at 100 rupees, 7 rupees is the income, right? Now, if the value of the rentals go up by 15% every 3 years, then the capital value of the REIT should also go up from 100 to 115.
15%.
Right?
Yeah.
So essentially 7 plus 5, 12% is the base yield from the asset that you can expect to get.
Okay.
So that is the base yield. But now there is another...
This is over a 3-year period.
This is over a 3 to 5 year period.
3 to 5 year
right?
period. Okay.
Now, let's come to the second component of the return. What often happens is, like bonds, right? Depending on where interest rates move, whether it goes up or down, the capital values of REITs also go up or down. Because you can pay more for the same asset if interest rates are lower, or you will end up paying less for that asset if interest rates move up. Because your expectation of yield changes basis what the interest rate is at that point in time. Because if you go to an FD, let's say in an FD, if you're getting 8% and in a REIT you're getting 7,
yes,
REIT is arguably a slightly more risky asset class because it's volatile. The prices are volatile.
Yeah.
Right?
Yeah.
So you'll go and put money in the fixed deposit.
Okay.
You will expect 9% from a REIT.
Right.
Similarly, if let's say the FD rates or the interest rates prevailing right now go down to 5 or 6%, you will be willing to buy the REIT at a 7% yield. So the prices move up of the REIT when interest rates go down,
fall. Okay,
and vice versa, right? So that's something in a technical parlance is called cap rate compression.
Okay,
right?
Lots of technicalities, but I think
Right.
what you've explained is this is really important because that capital appreciation part is not very well understood.
That's
Largely speaking, when interest rates are falling, REITs are supposed to do better.
Do better. So 3 components of returns we discussed. One is the income part. Second is growth in the income, which is the reset of the rentals.
Yeah.
And third is the capital appreciation. And then there are some minor nuances. Every REIT also keeps adding, inventory and, your returns keep going up. But broadly, these are the 3 components that one has to be very careful. So now in that context, last 1 year, the capital appreciation has been
20%,
extremely
25%.
good.
These REIT units, by the way, if you look at, you can do this, simply go online and look at 1-year returns from these REITs. And there's so many of them, right? There's Brookfield, there's, Mindspace, so many of these REITs, 5 REITs actually, which are now listed in India. If you plot a 1-year chart, then the gains are anywhere between, I think, 15 to, more than 15, 20%, 25% in some cases, right?
Right. So making an entry right now into these REITs, one has to be very careful in terms of what your expectation. Because the more the REITs deliver upfront, the back-ended returns tend to taper off.
That's a very important point, and we can only say this. Of course, investors will do their own thing. It just reminded me of the gold ETF flows. I was looking at the data that came out yesterday, right? In the months when gold was going through the roof, September and October, gold ETFs got the maximum amount of money.
Absolutely.
Because as investors, it's just behavioral sciences. I think we end up chasing returns. But Vishal, come in on this. So, Ashish has explained just the basic structure of how that REIT works. What has the experience of the past been? Because now we have several listed REITs. When we combine all these 3, the rental yield, the capital appreciation, the reset of rentals, how good has the return been from these products, say, over the past 2-3 years?
Yeah, so I think it's important to sort of look at different time frames because clearly the last 1 year has been fantastic for REITs. But the period before that, because REITs first got listed in 2019.
That was the first REIT.
That was the first REIT.
Brookfield.
So that was Embassy.
Embassy REIT, yes.
Right.
Yes.
And it's been about 6 years now. So it's been through these cycles. So when Embassy got listed, there was this shortage of REITs. It was the only one there. It suddenly saw a big move up. And then you went through COVID, you saw people work from home. A lot of people believed that, that's the future.
And
no one's
there's
going to go back to
never
commercial space.
return to office.
Never going to return to office. So you went through this period where, REIT returns were very subdued.
Yes.
You had interest rate cycles along the way as well. So I think, if you look at investors who've remained invested for long periods of time, their returns are quite normal.
And what does that mean? Define
So they've been
normally.
anywhere between 11 to 13% for long periods of time.
Okay.
Which is pretty much how the combination of rental yield plus the rent increase plus capital appreciation's been. But anyone who's come in the last 12 months has seen an abnormally high rate of return.
Absolutely.
And I think it goes back to the principle saying that, a REIT is also a long-term investment asset. And therefore, when you're buying into a REIT, even though it's income producing, and therefore there is a tendency to believe it's more like fixed income than an equity asset, I think the time frame definition is really important. And therefore, getting into REITs with a 7 to 10 year horizon probably is a good idea for investors because they'll go through these interest rate cycles. Typically, interest rate cycles last for 2 to 3 years on the way up, then they remain flat for 2-3 years, then they go down for 2-3 years. So you go through the entire cycle and you'll probably get a normalized rate of return.
Okay, so let's establish reasonable return expectations from this product first. Ashish, like Vishal is saying, that if you just normalize COVID onwards, the slump and the rise, and what history tells us is between maybe 11 to 13%. Now we can't extrapolate past returns into the future. Right. But would it be reasonable to expect 13 to 14% kind of a return from REITs, say over a 5 to 7 year period?
See, I would peg it more at 11 to 13. Right?
11 to 13.
If you get anything higher, I would say it's a bonus. Because look at it this way, right? And I'm just comparing it to stocks because it's easier for your viewers to understand, right? So if you take a stock, right, there is an earnings underlying a business, right? And typically your dividend yields are closer to 1 or 2% in stocks in India right now. So bulk of your returns come as capital appreciation. But in a REIT, what happens is that a large part of your returns come in the form of income, and some part comes in the form of capital appreciation.
Yeah.
Right? Capital appreciation comes because of rental reset plus cap rate compression. So just to give you a maths, 1% lower interest rates results in a 10 to 12% gain on the capital front. So part of the return capital gains has lower taxation, as you know, it's 12.5%.
12.5%,
right?
yeah.
Now, the other thing to consider is how are you getting the income from the REIT? So
and how is it going to be taxed? That's really important.
Right.
Let's understand that.
So there are two ways the REIT pays out income. One is dividends. There are some REITs which pay out more dividends. For example, Mindspace pays out more dividends.
Okay.
There are some REITs who pay out more interest income.
Okay.
For example, Embassy.
Okay.
Right? So return from interest income is taxed at MMR.
Your maximum marginal rate.
Maximum marginal. So for a person who's at the highest slab, it doesn't make sense. For a person who has a lower slab, it probably makes sense. But for a person at a higher slab, it makes more sense to get dividends.
Okay. And how are those dividends being
taxed? So dividends in your hands are tax-free.
Okay.
Right?
Okay.
They're taxed at the REIT level, which is lower than interest income at the marginal rate.
Okay.
So for people at the highest tax rate, probably the dividend makes a lot of sense.
Okay. And then there is capital appreciation, which is capital gains tax.
Which is capital gains tax. So the blended taxation is much lower than fixed income instruments. So the way to look at a REIT is on one side you have a fixed income instrument, right, which is giving you guaranteed income or certain income. And on the other side you have equities which are obviously uncertain depending on the earnings of the companies. This is a hybrid asset class in between.
Okay.
Because about 60-70% of the income comes from dividends or interest, and about 30 to 40% comes by way of capital appreciation.
Okay, got that. So now we've understood the brass tacks. We need to take a break, but after the break, we boil down to further specifics. There are 5 different listed REITs. They own different kind of assets. Like Ashish explained, some give you more interest income, some give you better dividends. How do you decide which one is right for you? And then we also look at changing regulations. SEBI has turned a far more favorable eye to REITs. What does that mean for us? We'll find out after the break.
Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week, we are demystifying the world of REITs, real estate investment trusts. And why are we doing that? Because they seem to be garnering a lot of interest now. Because A, commercial real estate has been booming in India, and B, the actual listed price of these REITs, that price has also been going higher. So therefore, it merits a closer look before you decide whether you want to invest or not. Vishal, let's talk about this, right? 5 listed REITs now in the country. Tell us a little bit, I mean, some nuances, and then how should we decide? Do you invest in all 5? Do you pick 1, 2, 3? How to go about it?
Yeah, so there are clearly 5, and one of them has got listed just very recently. So Embassy was where it all started from in 2019. So they are very Bangalore focused as a REIT. So one of the important things around REITs is they are in different geographies in terms of the concentration of assets that they have. So Embassy is very Bangalore focused. You have Brookfield, which typically has built its model around campus style spaces. So if you went to a college campus and you looked at mixed developments inside it, commercial, residential, retail, all together in those campuses, that's the Brookfield model. They're of course in other cities as well. So they are in the north. They've just made a large purchase in Bangalore. So Brookfield's their global player. You have Mindspace, which is very Hyderabad and Mumbai centric.
Okay.
So again, a lot of these REITs have tenants who are similar. A lot of technology, commerce, banking and financial services, global capability centers, especially Brookfield has 60% plus of its assets rented out by GCCs. So you've got that third player. You've then got Nexus, which is different because it has largely malls and retail spaces. Okay. So it's different from the other 3 simply because it's focused in a different area. Those malls are across the country. They continue to buy more mall assets and sort of create exposure. And then you've got the most recent one, which is Knowledge Realty, which was essentially put together by Blackstone and Satwa. So those are the 5 players who sit there. So there are going to be 3 sort of key elements that you think about. One is which geography do you really want to go to? So if you believe that Bangalore, for example, is the hub of where a lot of development and a lot of demand for these assets is going to come, then obviously a more Bangalore-centric REIT may be important. If you believe that you're trying to chase global players, then you'd probably want to look at something which has got Blackstone or Brookfield in it. If you want to look at the retail spaces, then it's Nexus. So I think one of the things that investors need to be very mindful of, besides what Ashish mentioned around how they pay out their income, is what is the kind of exposure that you want to really take as far as the REIT is concerned.
Do you want to be in offices? Do you want to be in a certain part of the country? Do you want to be in a narrow market? But that also raises another question. The question of concentration, because from what you describe, clearly technology and GCCs, that's a huge part of the whole REIT story. So from an investor perspective, if I'm looking to take an exposure to, say, a largely Bangalore-centric player where, technology tenants are the large chunk of that rental income, am I taking on too much risk?
So there is definitely risk in it. And I think, the risks come from the fact that those contracts which are there, a lot of them will have lock-ins in place. So I think it's important to understand how those deals are structured. It's also important to keep in mind when those deals happened, because there is a reset on rentals that happen over a period of time, because you end up doing a contract for, say, 9 years, for example. And when it comes up for a release conversation again, you could see appreciation happen on the price further because the rentals have gone up over a period of time. So I think there is nuances in this, and that's why it's important for investors to try to be diversified when they build their REIT portfolio. It's very tempting to just look at last 1 year returns, say,
hey, oh wow, great asset class, let's buy.
This is the best one to buy into. But I think you need to get into a little bit of detail, and ideally our suggestion is between 2 and 3 REITs is a good way to look at it, until the point where you start getting index solutions come in. You will probably see ETFs get created out of REITs, etc. But you'll be able to buy much more diversified.
Just buy the REIT index, so
exactly.
to speak.
You could buy a REIT index. So the REIT index is already in place. Unfortunately, there are no products based on the index yet.
Which brings me to the next part of the conversation, because maybe we're moving in that direction. So viewers, what has happened recently is that SEBI, in its latest classification norms, is now willing to look at REITs not as a hybrid instrument, but as actually equity, which means when mutual funds need to buy the equity part of their portfolio, along with buying equity stocks, they can also take more exposure to REITs. Now, what does this mean? It sounds great, equity exposure, etc. But Ashish, it also gets a little confusing, because at the end of the day, what is REITs? REITs is taking a bet on commercial real estate in India, right? I can also do that by playing the equity stocks of these developers, if I'm that convinced. So how does one decide, and especially with this new equity classification?
See, the difference is that, as I mentioned earlier, right, REITs have an inbuilt income, which stabilizes the volatility. Right? If you look at a stock, the earnings are far more volatile than, let's say, a rental income asset class.
That's true, very true. Great
so
point.
It's a great way for a portfolio manager to reduce the volatility in the portfolio. Plus, the classification on equity is a big advantage, because in hybrid funds, you can buy REITs and still enjoy the equity taxation, right? So the SEBI classifications of, let's say equity hybrid, equity minus hybrid. So these two categories, REITs can now substitute the equity part and bring down the volatility on the portfolio. So I do believe that you will see more exposure from equity funds or hybrid funds into REITs going forwards. I mean, they allowed 20%. And overall, as an asset class, right, today REITs, if you look at the market cap, is about 1.5 lakh crores. Okay, the AUM is about 2.5 lakh crores. It's about 0.3% of overall market cap. Globally, it's about 3%. So there is a lot of room for the market caps to increase, for the assets to increase, and I see a lot of more REITs getting listed. So there's another classification that SEBI has allowed REITs to come into, which is called the SM REIT.
Yes,
which
small
is
and
below 500 crores. We've not yet seen a REIT list there, but I do believe that going forward, you will see few more REITs listing in that category. So as an asset class, this is going to become fairly large. And like Vishal mentioned, I think for a retail investor, right, he can enjoy the best of both worlds. He can have REITs stabilize his volatility, plus you can diversify as well, because these are basically fractionalized units. Only thing to keep in mind is that REITs also are a play on the economy of the country.
Absolutely.
Right? So if the economic outlook improves, REITs will move up in terms of price and vice versa.
Yeah.
So from a near-term point of view, like he mentioned, like 5 to 10 years, it doesn't matter. Your returns will normalize to that,
11 to 13%.
10 to, let's say,
yeah.
13% bucket. But let's say if you're getting in today, I mean, you've seen a huge run-up over the last 1 year, then near-term returns may be lower and you may get returns
wait
slightly.
longer.
You have to wait longer. So those nuances one has to keep in mind.
Fair enough, and I think these are excellent points that both of you have raised because it gives us lots of food for thought before deciding to invest. I'm ending with the simple question, right? You go back to your portfolio. Now, the question is whether you should take direct exposure yourself, buy 2-3 REITs, as Vishal said, or should you let the fund managers do it for you because now mutual funds can technically buy a lot more REIT, right? And if you're doing it yourself, then as a part of the total portfolio pie, a well-diversified portfolio, at what level will you or would you want to cap that REIT exposure, Vishal?
So we think that till the products actually come in a material manner on the fund side, on REITs, investors may need to build this independently, especially keeping the tax structure in mind because of the way dividends are taxed relative to interest.
And do you have any favorites in that case?
So we think that Brookfield and Knowledge Realty may be good options to consider. It's important to have that time frame right, and it's important to keep looking at what's happening. So I think one of the important things that investors miss very often is there is an NAV that is published every half year by the REIT, and that's done by an independent valuer. So typically you will find that as market prices go up, you would find that there's a discount to NAV which becomes a premium. And normally when you start seeing big premiums to NAV, you need to be very careful about what's happening.
Okay.
So what you're seeing right now is a stage where the NAVs are very close to market prices, very small discounts or some premiums, which typically means that over shorter periods of time, investors may not make a lot of money until the NAVs itself get reset.
Okay.
And that's why it's important to
So watch for the NAV and they come out half yearly. Got that?
Right.
Final word with you, Ashish, to buy or not to buy. That's the $0.3 trillion question right now.
Yeah, so given that the exposure of mutual funds to REITs is still very limited, I do believe it makes a lot of sense for investors to build this allocation directly. Now, how much should it be? See, it can, as I said, it's a hybrid between an income generating asset and a capital gain asset. So it can be an in-between equity and debt, and it can still give you income. So for people who, let's say, want income out of their portfolio, this can be a very, very good option. And you could build maybe 10, 15 to 20% depending on what stage of life you're at.
And your need for income,
currently.
steady income.
And your need for income. And like I said, the other nuances to look at is how the income is coming, whether it's coming from dividend, it's coming from interest, and what is your marginal tax rate at that point in time. So I do believe that it makes sense to build exposure directly. But the only caveat is that look at it from a 3 to 5 year point of view, because by then, the volatility evens out.
All right, gentlemen, fantastic conversation. Thank you so much. And we've come such a long way, right? From the time where commercial real estate investment was only for the rich and famous. Now it is for you and me. But there are lots of details and nuances to keep in mind. So make sure you check all of this before you make the investment. Thank you for watching. We'll see you next week, same time, same place with another theme.
Let's talk money